The deadline to raise the debt ceiling is coming up. Is this a concern for investors or should we shrug it off? Well, we're here to discuss debt, problems with the economy, and macro projections with Lyn Alden, founder of Lyn Alden Investment Strategy. Welcome back, Lyn.
Hey, thanks for having me back. Always happy to be here.
A pleasure as always. Lyn, as you know, several weeks ago, Treasury Secretary Janet Yellen has issued a plea to Congress to raise the debt limit. Her quote is as following: defaulting on the national debt should be regarded as unthinkable, she said before a Senate hearing. And she said that failing to increase the debt limit would have absolutely catastrophic economic consequences. It would precipitate a financial crisis. It would threaten the jobs and savings of Americans, and at a time when we're still recovering from the COVID pandemic. Well, she's right. It is unthinkable because it's never happened before. The U.S. has never defaulted on its debt ever in its history. That's why treasuries are rated AAA. It would be unthinkable. So could the unthinkable be possible this time?
Well, it's technically possible each time. It's just one of those things that, pretty much by definition, it's a very, very low probability event. And if it were to occur, it would probably occur briefly and then be rectified. However, for example, some of the things that happened in say the capital of the U.S. earlier this year were previously thought unthinkable, and they still happen. So, investors have to watch out for these kind of tail risks that can happen. But in general, since the debt ceiling was implemented in the early 20th century, it's been raised something like 100 times, and so by both parties, and it's just it's historically been mostly a non-politicized event, but in certain periods of time it starts to be used as a tool, and so the way the debt ceiling works is you're not raising the debt ceiling for new debt. You're raising it to basically pay existing obligations that they've already signed into law, right? So it's not about new spending. It's about maintaining ongoing spending that they've already allocated. So it's different than, say, a fiscal stimulus bill or something like that. And so in some ways, it's philosophically counterintuitive to fight over the debt ceiling because, they already obligated that spending. But on the other hand, they use it as a practical tool to try to get something, from the administration when, because it's basically a strong bargaining chip. It's kind of like playing chicken.
Why even bother having a debt ceiling then?
Well, so originally, they had to approve every increase in the debt. But when the government became above a certain size, that became untenable. And so instead, they started to batch it together. And they said, okay, instead of approving every single one, we're going to we're going to allow a certain amount of additional debt to be issued by the Treasury. And so they would just kind of raise that every, period of time when that was reached. So it's basically a way that Congress can still have some degree of control over debt issuance, but simplify the process. And so, 9 times out of 10, it's not really a political event. But every kind of 10th time or so, that's when they can use it for more political gain.
Okay. So suppose they don't raise the limit. Let's just suppose that happens. What would be the immediate consequence? It means, of course, the Treasury can't borrow more funds to cover their existing debt obligations, which means they would have to default on some of their existing payment obligations, right?
Well, so they have a couple levers to pull at first. So they still have a cash at their account with the Fed. So the Treasury General account, they can draw that down. They also, they've been in this situation before where the debt ceiling was not raised, and they basically have some weeks or some months of juggling books around. They call it extraordinary measures to try to basically avoid some of the more tangible effects. And so they can do things like draw from the G fund of the federal retirement system that consists of treasuries, kind of unique treasuries. They can, basically they can eventually do a government shutdown where they reduce payments that are going out to different things. And that, that gets paid back afterward, at least part of it. The federal salaries get paid back, the contractors generally not. But basically they have a couple levers they can start pulling before they get to more serious things like Social Security checks not going out or Treasury coupon payments failing to deliver.
Yeah, that's never happened before, either of those things, right?
They've not gotten to that point. I think that there decades past there was some minor technical issue where a couple coupon payments were delayed, but those were not due to a debt ceiling issue. It was kind of a technical issue, so it's never really happened from a debt ceiling problem.
Can we talk about the politics behind deciding on raising the debt ceiling? What's with the gridlock right now? What are they negotiating that's taking so long?
Well, I mean, naturally, it's just a way to get different kind of brinksmanship. And so, for example, there's this ongoing infrastructure bill they're debating over, and it's as kind of public market participants, we don't necessarily know what they're talking about behind the scenes and what kind of deals that they're making. And so there could be any sort of things. It's also a way to kind of signal to your constituents that you're aware of the debt issue, and that you're basically doing your part to push back on it. So like most things in politics, there's kind of a theatrical aspect to it, but it is something to monitor. And so, even if the debt ceiling, doesn't cause that kind of tail risk catastrophic outcome, it can still have certain implications. Like, for example, during that period where the Treasury can't really issue new Treasuries, that can potentially issue rates. And ironically, it could be what's partially contributing to rates going down at the current time, even though in theory, it increases default risk, because it basically kind of threatens the supply of treasuries over the next kind of handful of months. And so when you have excess cash in the system, you have needs for collateral among financial institutions, and so that could ironically be pushing yields down to some extent.
Recall in December 2018, Trump shut down the federal government over disagreements on how to fund the budget for the following year. Speaking of theatrics, could that happen again? Because that would be really bad. It means a lot of government workers wouldn't receive paychecks during the pandemic.
Yeah, it's certainly possible. It happened under Trump. It happened under Obama, and it happened before then, but it's been more frequent in the past decade or so. And so basically, if that happens, there's certain kind of things in place where the federal workers would get paid back after that's over. That used to be in doubt, but now that's more kind of written in stone. However, the U.S. government also employs a large number of contractors, and they generally don't get that back pay, and so that basically would impact some of the spending patterns of people. Now, they can do things like go on temporary unemployment and things like that, but basically that would be a pretty notable but still mild economic disruption at a time when in some ways the economic growth variables are already kind of decelerating to some extent from their peak highs.
Okay, so Lyn, we know that the U.S. could technically raise the debt limit, but the problem is whether or not they could actually afford to raise the debt ceiling. This question has been posed to Jerome Powell before, whether or not we can afford it. At $30 trillion of gross national debt, we have the highest debt on record so far. This has been asked to Powell before, the issue of the interest rate rising to the historic level of 5.7%. At 5%, not even 5.7, but at 5%, we're looking at $1.5 trillion of annual interest expenses on $30 trillion of debt, assuming, of course, by that point, debt is still at $30 trillion. So could we afford that $1.5 trillion? And we have $3.5 trillion of tax revenues every year. So about half our tax revenues would go to interest expenses. Is the math right?
Yeah, for the early part of the question. So again, the debt ceiling is about funding that's already been allocated. And so the kind of the real question has to be directed to, can we afford further stimulus? Can we afford these kind of structural budget deficits that we have? And so those are kind of two separate debates, because one is about kind of fixing forward spending patterns, and the other one is about paying for previously allocated funding patterns. But going to the bulk of the question, the short answer is no. Basically, at $30 trillion in debt, 5% interest rates, as you pointed out, that would be $1.5 trillion in interest payments, which is a very large percentage of both GDP and specifically of government revenues and government spending. Now, there's a couple nuances there, because that refers to the average of debt outstanding. And so that would include, from the federal government, that would include short-term like T-bills, as well as that longer-term debt. And so that would depend on basically some of those long-term low interest rates have already been locked in. But there is a very, very large percentage of the treasuries that actually consists of short-term T-bills. Last I checked, I mean, well over 10 trillion was that very short-term number. And so that basically is tied to the Federal Reserve's interest rate policy. And so the short answer is my base case for a couple of years now is that, this looks a lot like the 1940s in the sense that that's the last time that U.S. debt to GDP was as high as it is now. And basically what they had to do back then was lock interest rates at a very, very low level, even when you had these bursts of inflation. And that's because they found themselves basically fiscally in a problematic space. And so the downside there is that if you're holding cash or holding bonds, you can fail to recoup your purchasing power during that period. And so that's actually one of the big differences between the 70s and the 40s, is that the 1970s, private and federal debt as a percentage of GDP were both pretty low. And so when you had inflation, you could raise interest rates to combat it. Whereas in the 40s, when you had very, very high public debts, despite inflation, pretty much whatever you do, they couldn't raise interest rates. And so that's generally a pretty good case for holding real assets at this current time because I think we're still on a path towards currency devaluation. And it could happen in bursts or it can happen just over the course of a decade of having interest rates that are below the inflation rate.
Okay, so let's first talk about the tools they have to control this problem. You mentioned locking in interest rates as one of them. What does that mean exactly? How can the government lock in interest rates?
Well, for example, if the government issues a 30-year bond at, say, 2.5%, then even if interest rates go back up, that bond, they still have a fixed contract of coupons to pay at that initial rate. And so basically the extent they lock in that longer term yield, they basically buffer themselves against rates going up. However, in recent period of time, they've actually been kind of decreasing their average maturity. They've been issuing a lot of T-bills. And so a very big chunk of that debt is susceptible to an increase in interest rates if the Fed were to do that.
Okay, so most of their debt is relying on variable interest rates, is what you're saying.
A good chunk of it, yes. I mean, they have that full spectrum from very, very short all up to 30 years, and a very big percentage of it is under 5 years.
Okay. Now, what about the possibility of interest expenses reaching? Is there a number in your mind, Lyn, where interest expenses become unsustainable, unaffordable? What's that number for you?
Well, once you would see kind of average treasuries getting up to maybe 3% or so, that'd become pretty fiscally kind of impossible. And I would actually already say at that point, at where we are now with both the United States and as well as some other developed countries, debt as a percentage of GDP pretty much almost mathematically can't be kind of serviced in real terms. Meaning that we're in an environment where most paths kind of point towards currency devaluation, and so that could take the form of, say, interest rates being 3% while inflation is 6%, or it could take the form of interest rates being 1% while inflation is 3 or 4%. And so there's a couple different kind of ways that could look like, but they all involve pretty much having these persistent periods of negative real yields, which is again that's a problem for pensioners, challenging environment for banks, and just challenging for any saver or bondholder.
All right, so currency devaluation is one consequence of the path forward. What about for the stock markets? Obviously, the high debt to GDP ratio is not anything new. It hasn't happened overnight. Yet, equity markets have continued to rally ever since 2009, if you ignore the blip we had last year. So this is something that I would think from the surface, at a surface observation, stock market investors have largely shrugged off. What do you think?
So in the 1970s, inflation was very, very bad for stocks because interest rates went up very quickly to combat that. And so when you have higher interest rates, you basically have you have to adjust your equity risk premium accordingly and pay lower valuations for stocks. Now the 1940s were different because despite inflation, they did not raise interest rates, and so stocks actually did pretty well in that decade from their initial lows around 1942. The difference now, though, is that stocks are going into this period of very, very high valuations, whereas back then they were very cheap. And so, the short of it is that it partially depends on what levers they're going to do. So if you just kind of run a massive deficit, keep interest rates below the inflation rate, do big currency devaluation, then equities can ironically do pretty okay, at least in nominal terms. They can kind of, maybe have a mixed outcome in real terms, do okay in nominal terms. Now, if on the other hand, that the government starts to kind of try to rein in this deficit issue, and they start to say raise tax rates on corporations, or they pull other levers, that could start putting serious downward pressure on equities if they decide to go that route. And so that's investors are watching big tech for regulation or tax changes there, as well as the idea of kind of a global corporate minimum tax. That sort of thing is should be on investors' radar.
All right. So to sum up, the equity markets are largely dependent on policies going forward. So let's break it down because you covered two different things: fiscal policy and monetary policy. So let's start with monetary policy first. As you mentioned, in the 70s, we had higher interest rates. Of course, the Federal Reserve back then was fighting I shied to use the word hyperinflation, but double-digit inflation in the early 80s and late 70s. We don't have that today. So is it necessary for the Federal Reserve to raise interest rates anytime soon?
Well, it depends on what their goals are. So again, my base case is that they're going to see inflation and not really raise interest rates. So right now, for
Sure.
example, CPI year over year is about 5%, and they still
Yeah.
have their interest rate policy at zero, roughly. And so that because of base effects rolling off, we're probably going to get under 5% pretty soon. But I still think that longer term, we're going to have impacts from rising wages, from energy prices staying somewhat elevated, and then potentially from rents kind of catching back up to some of the home price action we've seen.
Mhm.
And so I think that in some ways some of the base effects are transitory, but some of the actual inflationary effects are not. And I think the Fed is going to be very persistent at holding rates at a very low level. I mean, even if they do some of these very small rates that they're kind of forecasting now, like 50 basis points, that's still well below the prevailing inflation rate. And so I think going forward, they're probably just going to stay at that point, and so that helps make the debt more serviceable, but also weakens the currency in real terms.
Okay. All right. So on the fiscal side now, do you think the government is interested in closing the deficit gap, or are they just going to let it run and widen?
I think, I mean, that's, because there's so many different politicians with so many different persuasions. I think some of them are obviously very focused on the deficit issue. Other ones are not. We also have kind of different philosophies out there, among policymakers. So there's kind of the MMT approach that some policymakers are adopting. And in general, I mean, if you look at some of the policymakers, what they've written, this has been kind of known. And so, for example, there was a BlackRock paper that had input from the former Fed vice chair, about basically the need that, they wrote this back pre-pandemic, but they said during the next downturn, you probably would see very large fiscal injections, but then holding interest rates low anyway, even if inflation runs hot for a period of time. And so they seem to be aware that this is, essentially a monetary issue, and it affects, both the fiscal budget and the currency. And so I do think that there are different, policymakers aware of it, but they don't really have a lot of tools at this point to deal with it, because if they try to close that gap, that would impact a lot of financial assets, which ironically, because the United States is so financialized, that would impact GDP, most likely consumer spending and GDP. On the other
Mhm.
hand, if they let it run hot, then they risk kind of an acceleration of currency devaluation. And so they're kind of at this point where they have to pick their outcome, and both of them have consequences.
I think the government, correct me if I'm wrong, Lynn, but I think the government, most governments would want currency devaluation, right? That would be better for exports.
So most governments do. Most of them want that kind of gradual devaluation, where they still want their currency to be seen as stable, but they want
Mhm.
some positive inflation rate. Now, so far, I mean, during the kind of the path of the previous decades, the United States has not really played that currency devaluation game at the rate that others have, in the sense that when you have countries like Switzerland, for example, purposely devaluing their currency as much as possible to kind of counteract the fact that it would otherwise strengthen quite a bit, because they're running very, very large current account surpluses. So they basically print money, they buy foreign assets for the specific purpose of trying to devalue their currency. Now, the United States, on the other hand, does not use foreign exchange reserves. We have very, very little foreign exchange reserves as a percentage of GDP, because the United States has historically been the axiom of the system, where other countries use the dollars as exchange reserves, but we don't really have their currencies as exchange reserves. So the United States actually could play this game more aggressive if they wanted. They could just print dollars and buy foreign bonds and things like that. But so far, they've not done that. And so that's mostly been a
Mhm.
game that China's played, Switzerland's played, a number of these other countries have played. Now, again, it's one of those things where if you're an exporter, then yes, you benefit very much from currency devaluation. Whereas if you're a consumer or a holder in that currency, those are the ones that get hurt. So basically,
Okay.
politicians have to kind of balance those different groups and who they're trying to please at any given time.
So putting all this together then, Lynn, what's your outlook for the equity markets for the remainder of the year, given that your base case is zero interest rates for the foreseeable future and the possibility of the raising of corporate taxes and potentially capital gains taxes to combat this deficit gap?
So I think overall, I mean, it'll depend on certain levers they could pull. It'll depend on certain virus variants that are hard to predict. However, I do think that in terms of the looking at the probability of forward returns here, it's certainly a less attractive environment for equities than it was, say, this time last year. right? Because we've had such a strong run. We generally have high valuations across the board. And so I think it's a good idea to, kind of go through your portfolio and make sure you know what you own. Make sure you understand what the cash flows are, the revenues, the growth, because I do think, we're in a very mixed environment where many stocks look like bubbles, whereas other stocks are still kind of historically cheap out there. And so I think
Right.
you're in a very different performance in different sectors. And overall, I would consider having a somewhat defensive tilt at this time.
So, Lyn, if you compare the US debt to GDP to that of foreign countries, for example, Japan, it's actually not that bad. So, for example, the US has a debt to GDP of roughly 100%, 105, depending on the source. Japan has twice that, 237%, according to the source I'm looking at. So, is debt to GDP or aggregate debt an issue for you as an investor? Is that something you consider when picking jurisdictions across the globe?
So certainly one of the variables that impacts currencies and other issues like that. And there's a few variables to consider. So one is whether or not the country controls the currency that it owes the debt in. And so I'm actually
Okay.
more worried about some
Yeah.
of those Southern European countries that have very high sovereign debt to GDP in a currency that they can't even control. So that means actually nominal default risk is potentially higher because they're reliant on the ECB to basically make their debt serviceable. Japan's an interesting case because they have the highest sovereign debt in the world as a percentage of GDP, but they control their own currency. And if you look at, for example, a lot of this debt kind of came out of the corporate sector. So, 20 years ago, Japanese corporates were very, very leveraged. Whereas now that's kind of shifted over to the sovereign level where their corporates, they actually have as much cash as debt on average. Basically, if you
Okay.
look at kind of the broad index. And so actually, I find Japanese equities to be reasonably attractive, whereas the basically Japan's public finances are another story. And so basically, if you look around the world, I just kind of did a report where I looked at over 30 countries, for example, at their different debt to GDP ratios, both for the sovereign and corporate and household levels. And you see kind of pockets of bubbles in different places. So some countries have housing and basically consumer debt at very high levels. Other ones have sovereign debt at very high levels, and other ones have corporate debt. And so, overall, depending on what I'm focusing on, if I'm focusing on equities in a country, for example, I'm more interested in corporate debt than I am at sovereign debt, unless it's one of those countries where they don't even control their own currency, and then you have risk of a financial crisis.
Okay, I don't mean to leave the audience hanging here, but in the second part of our interview, we're going to address the question of whether or not a country could start issuing debt in Bitcoin.